The following analysis is strictly for educational purposes and does not constitute investment advice. Traditional analysts value heavy manufacturing companies using rigid, cyclical frameworks. They assume commodity-level margins, capital-heavy traps, and volatile boom and bust demand cycles. Applying that industrial framework to GE Vernova is a severe categorization error. The company actually operates with the economic architecture of an aerospace engine manufacturer. Think of companies like Safran or Rolls-Royce. Their true profit doesn't come from selling the physical engine. The economics rely entirely on the multi-decade service agreements that follow. GE Vernova applies that exact same economic model, but instead of putting engines on airplanes, they plug them directly into the global electricity grid. Pricing this specific business with standard industrial valuation multiples masks its compounding power. GE Vernova is the $38 billion power generation spinoff from General Electric that hit the public markets in April 2024. To understand the cash flow, look at this B2B value chain. As the original equipment manufacturer, or OEM, Vernova sells massive physical assets directly to regulated utilities, independent power producers, and hyperscalers. There is no volatile, two-sided consumer marketplace here. It is a rigid, direct-to-enterprise relationship built on massive capital assets. This is the crown jewel of their physical product line, the HA-class heavy-duty gas turbine. When Vernova sells one of these turbines, the initial heavy equipment sale generates a very modest 8 to 12% gross margin. But that equipment sale contractually locks in a 20 to 25-year multi-year service agreement. That back-end contract captures 40 to 50% gross margins on maintenance and proprietary hot section parts. The physical turbine acts essentially as a loss leader. What GE Vernova is really selling is a highly profitable, multi-decade service contract disguised as heavy machinery. To understand the balance sheet, we must recognize that GE Vernova operates as a three-speed machine comprising power, wind, and electrification. This chart breaks down projected revenue. The orange base layer is the power segment, the central engine generating 52% of revenue, growing toward $28.8 billion. Above that, the red wind segment is intentionally shrinking as management winds down unprofitable offshore contracts. They are maintaining the onshore wind assets, like the turbines at this industrial site, because those operations are successfully turning a profit. Returning to the chart, the blue top layer is electrification. This is a high-growth vehicle designed to monetize the current transmission supercycle, growing at roughly a 22% compound annual rate. That segment was aggressively scaled by their recent $5.3 billion acquisition of Prolec, instantly making Vernova a top 2 global player in high-voltage transformers. These three segments operate together as a hedged portfolio. The highly profitable legacy power business generates the cash required to aggressively build out modern grid infrastructure. Looking at the historical fundamentals table, pay attention to the return on invested capital row. The reported 30.2%. They achieve this metric because the company operates with an inverted tangible capital base, meaning they carry virtually zero net leverage. The exact mechanism is negative working capital. A massive $25.8 billion pool of contract liabilities far exceeds their receivables and inventory. Operationally, utilities prepay for turbines, funding manufacturing 24 to 36 months before the equipment is delivered. Because the customers front the cash, Vernova can execute a $3.5 billion capital return and CapEx program without taking on traditional debt. The protective moat that guarantees these prepayments keep flowing is the proprietary metallurgy used to cast their single-crystal turbine blades. Only the original manufacturer possesses the IP to service these advanced alloys, creating an insurmountable switching cost of $20 to $40 million per turbine. And Vernova has an installed base of 7,000 units. GE Vernova's true financial advantage is that its customers, rather than its shareholders, finance its operations. You can see the result of this structure in the Q1 2026 earnings print. This chart of quarterly revenue and adjusted EBITDA highlights a massive 96.1% year-over-year spike in profitability. The company is engineered to expand from an 8.4% margin in 2025 to 22.2% by 2028. The first driver is volume scaling. HA turbine orders accelerated from 8 to 43 in a 3-year window, drastically lowering fixed cost per unit. The second driver is wind drag removal. Killing off unprofitable offshore wind contracts eliminates a massive drain on aggregate EBITDA. The architect executing this exact operational pivot is GE Vernova CEO Scott Strazik. Strazik spent 20 years inside the GE ecosystem, where he successfully executed the turnaround of GE Gas Power from 2018 to 2024. He operates inside a clean governance structure. The company uses single-class stock, where voting rights strictly equal economic rights, overseen by a board that is 87.5% independent. This rapid margin expansion is being driven by a leadership team precisely aligned with shareholder outcomes and proven in industrial turnarounds. So how should the market value this specific economic machine today? Against traditional industrial peers, the mispricing is obvious. Vernova trades at a PEG ratio of 2.2, while peers like Caterpillar sit above 6. This valuation yields a conservative base case internal rate of return between 17 and 22% over 5 years. The final question for an investor is timing. Why is this specific acceleration happening right now? The macro catalyst is the explosive scaling of AI compute and hyperscaler data centers. They require massive, continuous baseload power that intermittent renewables cannot supply. That immediate energy deficit pulls equipment orders forward into Vernova's power segment today, which mathematically locks in the next 30 years of high-margin service annuities. And while the macro thesis plays out, the $25.8 billion in prepaid contract liabilities acts as a massive shock absorber against short-term economic downturns. GE Vernova is a mispriced aerospace-style compounding machine hiding in plain sight, with the exact technology required to power the next era of global infrastructure.